Welcome to Money RX for CRNAs and nurse practitioners. I'm Brett Fellows, and I'm really glad that you are here today. Now, if you're listening to this, chances are you have built an incredible nursing career. Whether you are a nurse practitioner, a clinical nurse specialist, or a CRNA, you have worked long shifts, held everything together in high-stress situations, and you have poured yourself into your patients and your family. And if you're a high earner making $120,000 as an NP or $200,000 plus as a CRNA, you probably think that your investment strategy is solid. I mean, you've been saving in your 403b, maybe maxing it out every year. You've got money in taxable accounts. You should be on track for retirement, right? Well, I have some news for you. I had a conversation recently with a CRNA couple. They had been saving diligently for 25 years. They had nearly $2 million in their 403b accounts. They thought they were doing everything right. But then they sat down to actually run the retirement numbers. And they discovered something shocking. Because of the investment decisions they'd made over the years, they'd need to work an extra 5 to 7 years to reach the same retirement lifestyle they could have had with a better strategy. That is 5 to 7 more years of night shifts, 5 to 7 more years of being on call, 5 to 7 more years of the physical and emotional demands that come with being a CRNA, all because of investment mistakes that they didn't even know they were making. So the problem isn't that they weren't saving. They were saving plenty. The problem was how they were investing. But there's an even deeper issue here that affects nurses specifically. Many nurses, as I just said, work in high-stress careers where burnout is real. So you might be planning to retire early than originally expected because the physical and emotional demands become unsustainable. But if you're making these investment mistakes, you might actually be adding years to your working life without even realizing it. You might think, I'll work until I'm 60, then I'm done. But poor investment decisions could mean you actually need to work until 65 or 67 to reach the same level of financial security. And that is the cost of these mistakes, not just lower returns, but more years away from the retirement that you deserve. And most nurses don't discover these problems until it's too late to fix them easily. No one prepared them for these pitfalls. No one explained what actually matters in investing. No one showed them a better way. So today, I want to walk you through the 10 biggest investment mistakes that I see nurses making. These are not academic theories. These are real mistakes costing real nurses real years of their lives. So let's get into it. Mistake number 1, trying to time the market. You know what I hear all the time? Brett, I am waiting for the market to drop before I invest. Or, you know what? I moved everything to cash because I think we're headed for a recession. Or, I'll get back in after things settle down. Well, let me tell you something. 98% of investment performance comes from behavior, not from what you know. And the single worst behavior is trying to predict when to get in and when to get out of the market. You can't do it. I can't do it. No one can do it consistently. Studies show that investors who try to time the market typically underperform by 3 to 4% per year compared to investors who just stayed invested. Now, that might not sound like much, but over 30 years on a $500,000 portfolio, that 3% difference costs you nearly $1 million. And that's the cost of trying to be smart about when to buy and sell. If you are sitting on cash right now, waiting for the right time, you are making one of the costliest mistakes possible. Mistake number 2, letting emotions drive your decisions. Now, this ties directly into mistake number 1, but it is worth talking about separately because emotions show up in so many ways. Panic selling when the market drops. That is emotion. Getting greedy and buying stocks because everyone's talking about them. That's emotion. Checking your portfolio every day and making changes based on short-term moves. That is emotion. I will tell you what I tell all my clients. Most of the issues I have seen are the decisions people make because of emotions rather than what they picked or what they didn't pick. You know what happens when you let emotions drive? You sell low and buy high, the exact opposite of what you should do. Now, the solution? Have a plan. Stick to the plan. Do not look at your portfolio every day. And if you are investing for retirement 20 years from now, what happens in a single day or a single month or even a single year, frankly, doesn't matter if you are investing for the long term. Mistake number 3, not having proper diversification. This one kills me. I see nurses all the time with portfolios that look like this. 70% in large cap US stocks, 20% in bonds, and 10% in cash. Or worse, everything in a target date fund that is essentially just tracking the S&P 500. You know what that is? Concentration risk. When I say diversification, I mean real diversification. International stocks, emerging market stocks, small cap stocks, real estate investment trusts, different bond types. 95% of investment performance comes from asset allocation, not from picking the right individual stocks, not from timing the market, but from how you divide your money across different asset classes. Most nurses have way too much concentrated in large US companies. Now, when tech stocks drop, your whole portfolio drops. When large cap growth underperforms, your whole portfolio underperforms. That is not a diversified portfolio. That is a concentrated bet that you didn't even know you were making. Mistake number 4, paying excessive fees and costs. Let me ask you a question. Do you know what you are paying in investment fees? Now, most nurses I talk to have no idea. They might know that their advisor charges 1%, but they don't realize that the mutual funds that they're in charge another 1%. Or they're in actively managed funds with expense ratios of 0.75% or 1%, when they could be in index funds that charge 0.05%. That seems small, right? Wrong. A 1% difference in fees on a $1 million portfolio over 30 years costs you more than $600,000. And that is not a typo. Over $500,000. So, what affects performance more than anything else? Costs. You need the least expensive, most properly diversified asset allocation you can get. Not the flashiest, not the one with the most marketing, but the cheapest one that does the job. Mistake number 5, chasing past performance. Brett, this fund has returned 15% for the last 5 years. Great. What does that tell you about the next 5 years? Absolutely nothing. In fact, funds that have had the best performance in the previous 5 years are statistically more likely to underperform in the next 5 years. Why? Because performance attracts attention. Attention brings money. Money makes the fund harder to manage. And whatever it was that made the fund successful, and usually it's a specific market condition or sector, stops working. About 80% of actively managed funds underperform their benchmark over time. And the ones that do outperform, most of them don't keep doing it. So you know what that means? That chasing performance is a losing game. But nurses do it all the time because it feels good to invest in winners. But until those winners become losers and you have bought them at the top. Mistake number 6, not reinvesting dividends. Now this one is simple, but I see it all the time. Nurses who take their dividends as cash instead of reinvesting them. If you are 35 or 45 or even 55 years old and you do not need that dividend income right now, you should be reinvesting it automatically. Because dividends reinvested buy you more shares. More shares generate more dividends. So that is compound growth in action. If you're taking dividends as cash and spending them, or even just letting them sit in a money market, well, you're giving up years of growth. Now, of course, if you're retired and living off of your portfolio, different story. But if you're still working and building wealth, reinvest those dividends. Mistake number 7, ignoring tax efficiency. Most nurses focus on investment returns. But you know what matters more? After-tax returns. I have seen nurses with great investment performance who end up with mediocre results because they didn't think about taxes. Short-term trading in taxable accounts? Well, you're paying ordinary income tax rates on those gains. Now that could be 30 to 40% depending upon your bracket. Holding the wrong types of investments in the wrong types of accounts? Well, you're paying more tax than you need to. Not doing tax loss harvesting when you have losses? You are missing opportunities to reduce your tax bill. Most nurses think tax planning is something you do in April. No. Tax planning is something you do every time you make an investment decision. Where you hold your investments matters. When you sell matters. What you do with the losses matters. So this is one area where working with someone who understands tax planning can save you tens of thousands of dollars. Mistake number 8, active stock picking instead of evidence-based investing. So I'm going to be blunt here. If you are picking individual stocks, you are probably losing money compared to what you could be making. I know that's not what you want to hear, but the evidence is overwhelming. About 80% of professional investors who do this for a living and have teams of analysts and expensive software underperform simple index funds. So what makes you think you are going to be in the top 20%? I use an evidence-based investing approach. That means using academic research to construct portfolios, not predictions, not hot tips, not trying to find the next Amazon, but research, evidence, and data. Avoid concentration in popular sectors. Reduce reduce risk. Target higher expected returns based on decades of market data. And that is how you build wealth, not by trying to pick the next big winner. Mistake number 9, not rebalancing your portfolio. Let's say you decide you want 70% stocks and 30% bonds. Good start. But then stocks have a great year. Well, now you're at 80% stocks and 20% bonds. So what do? Most people do nothing. They just let it ride. And that is a mistake, because now you are taking more risk than perhaps you intended. And when stocks drop, which they will eventually, you are going to drop harder than you planned for. So rebalancing means periodically selling some of what's done well and buying more of what hasn't. It forces you to sell high and buy low. It keeps your risk level consistent, and it is one of the most important but most overlooked parts of investing. If you are not rebalancing at least once per year, believe me, you are making a mistake. And last but not least, mistake number 10, investing before addressing financial basics. So I saved this one for last because it is foundational. I see nurses all the time who are putting money in the market, but still have credit card debt, or no emergency fund, or inadequate insurance, or no estate plan. You know what? Investment returns don't matter if a financial emergency forces you to sell your investments at the worst time. So before you invest $1, you need an emergency fund with 3 to 6 months of expenses, high interest debt paid off, adequate insurance to protect your income and your family, a will and beneficiary designations that actually reflect your wishes. Only then should you start building an investment portfolio, because investment is about building wealth, not recovering from financial emergencies. So there you have it. The 10 biggest investment mistakes I see CRNAs and nurse practitioners make. Now, let me be clear about something. These mistakes are not about being careless. They are not about not caring enough. They happen because no one ever taught you what actually matters in investing. No one explained that behavior matters more than stock picking. No one showed you what real diversification looked like. No one helped you understand the power of low costs. But now you know. So, what do you do with this information? Well, if you're making any of these mistakes, don't panic. Most of them can be fixed. If you are trying to time the market, stop. Get invested, stay invested. If you are not diversified, start building a properly allocated portfolio. If you are paying high fees, move to lower cost options. If you are picking individual stocks, consider moving to evidence-based funds. If you are not rebalancing, set a reminder to do it annually. The key insight is this: investing isn't about being smart. It's about being disciplined. It's about having a plan and sticking to it even when it's uncomfortable. It's about understanding that long-term success comes from avoiding mistakes, not from making brilliant predictions. And this is why financial planning matters. It's not just about picking investments. It's about understanding how the investments fit into your entire financial life, how they interact with taxes, how they support your retirement goals, how they need to change as you get older. As a nurse, you have spent your entire career taking care of everyone else, your patients, your families, your communities. You deserve a retirement that comes sooner rather than later. You deserve to stop working when you want to, not when you have to. And avoiding these 10 mistakes, that is how you get there. If you are a CRNA or a nurse practitioner and this episode raised questions about your own situation, do not wait to address them. The decisions you make now about how you invest can add years to your retirement or subtract years from your working life. The choice is yours. But at the end of the day, you don't have to figure it out alone. Thanks for listening to Money RX for CRNAs and nurse practitioners. I am Brett Fellows, and until next time, take care of yourself and take care of your money.
This podcast is for informational and entertainment purposes only. It should not be relied upon as a basis for investment decisions. This podcast does not engage in rendering legal, financial, or other professional services.